Look at your most recent bank statement. Look at the exact amount that was automatically deducted on the first of the month for your mortgage. You likely felt a quiet sense of relief when that transaction cleared. You told yourself that you survived another month of punishing interest rates, that you are successfully weathering the economic storm, and that slowly but surely you are inching closer to owning your home free and clear. That feeling of relief is an illusion, and it is exactly what the Canadian banking system is counting on to keep you complacent. Because while you are patting yourself on the back for making your fixed monthly payment on time, a silent algorithm deep inside your bank's server is busy adding thousands of dollars of invisible debt right back onto your property. You are not paying off your house. You are renting your own debt, and the financial institution you trust is quietly waiting for the clock to run out so they can hand you the most devastating bill of your life. Welcome back to Canada Property Watch, where we dismantle the complex hidden machinations of the Canadian financial system that are currently engineering the greatest wealth transfer in modern history. Today, we are exposing the ultimate financial time bomb ticking inside the Canadian housing market. It is a trap so perfectly designed, so quietly executed, that millions of homeowners are currently caught in it without even realizing it. Today, we are going to break down the terrifying reality of negative amortization, the trigger point, and the catastrophic lump sum trap that awaits you at renewal. And to understand the sheer scale of the catastrophe that is unfolding across the Canadian middle class right now in 2026, we have to travel back to the psychological frenzy of the pandemic housing boom. During this era, money was practically free. The Bank of Canada had slashed the overnight lending rate to emergency lows. Home buyers were frantic, bidding hundreds of thousands of dollars over the asking price just to secure a piece of the Canadian dream. To help buyers afford these wildly inflated prices, the major financial institutions aggressively pushed a very specific, very seductive financial product, the variable rate mortgage with a static payment. This product was marketed as the ultimate safety net. You get to take advantage of the ultra-low interest rate of a variable mortgage, but with the budgeting security of a fixed monthly payment. The mortgage broker sat across the desk from you, smiled, and explained that if interest rates ever went up, your payment would not change. The bank would simply adjust the math behind the scenes. You would just pay a little more toward interest and a little less toward the principal. It sounded brilliant. It sounded safe. It was, in fact, a financial Trojan horse designed to maximize bank profits while shifting all the systemic risk onto your shoulders. What the brokers completely failed to emphasize, and what the banks actively downplayed in their glossy marketing materials, was the mathematical breaking point of this arrangement. A mortgage payment is essentially a pie chart. One slice is the principal, the actual money you borrowed to buy the house. The other slice is the interest, the fee the bank charges you for the privilege of borrowing their money. When interest rates were at rock bottom, the interest slice was tiny. Most of your static payment was going directly toward paying down your principal. You were building equity every single month, but then the macroeconomic environment violently shifted. Inflation raged, and the central bank began the most aggressive rate hiking campaign in modern history. As the prime rate climbed higher and higher, the internal math of your fixed payment began to warp. The interest slice of your payment pie grew larger, and the principal slice grew smaller and smaller until it was barely a sliver. Eventually, hundreds of thousands of Canadian homeowners hit a mathematical wall known as the trigger rate. At the trigger rate is the exact moment when the interest you owe the bank for that month is perfectly equal to your entire monthly payment. At this precise point, the principal slice of your pie disappears completely. You are no longer paying down your debt. You are just renting the money from the bank. But the central bank did not stop hiking rates. They pushed them even higher, keeping them elevated for longer than anyone predicted. And this is where the system crosses the line from a heavy financial burden into a mechanism of absolute wealth destruction. When the interest owed exceeds your static monthly payment, you hit the trigger point. You are now officially in a state of negative amortization. Let us break down exactly what negative amortization means, because it is the silent cancer that is destroying your financial future. Suppose imagine your fixed monthly mortgage payment is $3,000. But because interest rates have skyrocketed, the actual interest the bank is charging you for that month is $4,000. You are short $1,000 every single month. Does the bank call you and ask for the $1,000? Do they warn you that you are falling behind? No, they do something much more insidious. The bank quietly takes that unpaid $1,000 in interest and adds it to your total mortgage principal. You started the month owing $500,000 on your house. You made your $3,000 payment perfectly on time, but because of negative amortization, you wake up the next month owing $501,000. The next month, you owe $502,000. You are paying the bank every single month, but your debt is growing larger and larger. You are literally borrowing money from the bank just to pay the bank the interest you owe them, and they are charging you compounding interest on that unpaid interest. Because your debt is growing instead of shrinking, the timeline to pay off your house explodes. When you signed your mortgage, you agreed to a 25-year amortization period. You had a clear path to being debt-free, but under negative amortization, the math breaks down. The algorithms inside the banking system recalculate your timeline based on the fact that your principal is expanding while your payment stays the same. Suddenly, your 25-year mortgage becomes a 40-year mortgage. Then it becomes a 60-year mortgage. We have seen internal bank documents showing Canadian homeowners whose amortizations have technically stretched it to 90 years or even infinity, because their monthly payment will mathematically never be enough to pay off the accumulating interest, let alone the original debt. The bank allows this to happen silently in the background for years. They do not foreclose on you immediately. They do not panic. Why? Because the bank is highly profitable in this scenario. They are legally allowed to count that unpaid capitalized interest as revenue on their balance sheets. You are acting as a compounding interest machine for the financial institution, and they are perfectly happy to let the clock run out on your term while you unknowingly dig your own financial grave. But the clock always runs out. And this brings us to the devastating reality of the renewal cycle. In Canada, unlike in the United States, you cannot lock in a mortgage rate for 30 years. You sign a contract for a specific term, usually 5 years. When that 5-year term expires, your contract with the bank is over. You must negotiate a brand new contract at the current market rates. Between late 2025 and 2027, over $300 billion worth of these variable rate, fixed payment mortgages are coming up for renewal. This is the massive wall of debt that economists have been warning about, and it is finally making landfall right on the kitchen tables of the middle class. When your renewal date arrives, the illusion of the static payment is violently shattered by the heavy hand of federal banking regulations. From the Office of the Superintendent of Financial Institutions, known as OSFI, is the federal watchdog that regulates Canadian banks. OSFI has a very strict rule. While they turned a blind eye and allowed banks to let amortization periods stretch to 70 or 90 years during the term to prevent an immediate housing crash, they strictly forbid a mortgage from being renewed with an extended amortization. When your 5-year term is up, OSFI mandates that the mortgage must snap back to its original contractual timeline. If you signed a 25-year mortgage 5 years ago, your new renewal contract must be structured to pay off the entire remaining balance in exactly 20 years. There are no exceptions. The regulatory forbearance is over, and the banks use OSFI as the perfect bureaucratic shield to enforce their demands. And this regulatory snapback is the exact mechanism that triggers the lump sum trap. Let us look at the terrifying mathematics of your renewal letter. 5 years ago, you borrowed $500,000. Because of negative amortization, your balance did not go down over those 5 years. Instead, the unpaid interest was piled on top of your debt. Today, at renewal, you do not owe $450,000 like you planned. You owe $560,000. And remember, OSFI rules state that this inflated balance of $560,000 must now be paid off in a compressed timeline of just 20 years at today's high interest rates. The bank's underwriting software calculates the new reality, and the computer spits out an ultimatum. The bank sends you the renewal letter in the mail, and they give you a choice. But it is a choice between two different forms of financial ruin. Option 1, the bank will renew your mortgage, but your monthly payment will no longer be $3,000. To kill the negative amortization and force the inflated principal into the 20-year box, your new payment must be $6,500 a month. This is the payment shock. It is a 110% increase in your housing cost overnight. For the vast majority of Canadian families whose wages have not doubled in the last 5 years, this option is a mathematical impossibility. It would require them to stop buying groceries, stop paying for utilities, and stop living. When the homeowner calls the bank in a panic, desperate for a lifeline, and says they absolutely cannot afford a $6,500 monthly payment, the recovery officer on the other end of the line calmly presents option 2. This is the lump sum trap. The bank officer explains that if you want to keep your monthly payment at a manageable level, you must manually shrink the size of the principal debt before the new contract is signed. The bank demands that you write them a check right now for $100,000 cash. This lump sum payment is required to bring the principal balance down to a level where the math works within the strict OSFI regulations. You hear this demand and your mind goes blank. $100,000 in cash. You do not have $100,000. Your savings were depleted by years of crushing inflation. Your emergency fund was drained by the rising cost of groceries and gas. Your entire net worth is tied up in the equity of the house itself, equity that the bank's own interest charges have been secretly eating away. You ask the bank if they can just add it to the loan. The bank says no. That is what caused the problem in the first place. You ask if they can extend the amortization to 30 years to lower the payment. The bank says no. Federal regulations prohibit it. You ask for a payment plan. The bank says no. The term is expiring. The contract requires immediate settlement. The bank has drawn a line in the sand. You either produce a massive pile of liquid cash, you agree to a monthly payment that will bankrupt your family, or the bank will initiate a power of sale, evict you, and auction your home to the highest bidder to recover their funds. This is the moment of maximum extraction. The system was designed to push the pain down the road, to keep you paying the maximum amount of interest for 5 years, and then to force a reckoning when you have no leverage left. The banks knew exactly what they were doing when they allowed negative amortization to run rampant. They were stress testing your compliance. They were betting that when the renewal day came, you would do whatever it takes to save your home. You would swallow your pride and borrow from your elderly parents, draining their retirement funds and putting them at risk. You would cash out your RRSPs, destroying your own retirement and taking a massive tax penalty from the CRA in the process. You would take on high-interest private loans, but plunging yourself deeper into the shadow banking system just to satisfy the major bank's demand for a lump sum payment. The bank's risk management strategy is to squeeze every last drop of liquidity out of your extended family network before they finally pull the plug on the asset. But what happens when you cannot find the cash? What happens when the bank of mom and dad is empty, when the credit cards are maxed out, and when the retirement accounts are drained? This is where the structural integrity of the Canadian real estate market begins to fracture on a national scale. The homeowner is forced to reject the renewal offer because they simply cannot meet the conditions. The bank then issues a demand for the entire balance of the loan. Because the homeowner cannot pay, they are forced to list the property for sale in a desperate, last-minute attempt to avoid foreclosure and a destroyed credit rating. This dynamic is triggering a massive wave of forced inventory hitting the market right now. We are seeing thousands of homes being listed not because the owners want to move, not because they want to upgrade, but because they are fleeing the lump sum trap. They are trying to sell the asset to pay off the inflated mortgage balance before the bank seizes it. But they are listing their homes in a market where buyers are terrified, where interest rates are punishing, and where the banks are aggressively utilizing the appraisal trap we discussed in our last video to deny funding to new buyers. It is a perfect storm of forced selling and zero liquidity. As these desperate sellers slash their asking prices to beat the bank's foreclosure deadline, they are dragging down the comparable sales values for the entire neighborhood. The equity of every homeowner on the street is being vaporized by the distress of the people caught in the renewal trap. Furthermore, we must address the psychological devastation this tactic inflicts on the population. The Canadian financial system relies on a narrative of trust. You are taught to trust your bank. You are taught that if you make your payments and play by the rules, the institution will work with you during hard times. The lump sum trap shatters that social contract contract permanently. It exposes the cold, algorithmic reality of modern banking. When you call the retention department pleading for a solution, you are not speaking to a community banker who cares about your family's well-being. You are speaking to a call center employee whose screen is locked by underwriting software. The computer dictates the terms. If the loan-to-value ratio is breached, if the debt service ratios are exceeded, the computer says no. There is no empathy. There is only risk mitigation and capital preservation. The bank views your inability to produce the $100,000 lump sum as a critical failure of your creditworthiness. You are immediately downgraded from a valued client to an active liability that must be purged from the balance sheet. You must also understand the insidious role of the collateral mortgage in this trap. When you initially bought your home, you likely signed a collateral charge mortgage without fully understanding the implications. A collateral charge allows the bank to register a lien on your property for an amount much higher than your actual loan, sometimes up to 125% of the property's value. The broker told you this was a benefit, allowing you to easily borrow more money in the future for renovations without paying new legal fees. But in a negative amortization scenario, the collateral charge becomes a weapon. It ensures that as your debt grows every month, the bank's legal claim over your property expands with it, perfectly securing their accumulating interest. You cannot escape by refinancing with a different, smaller lender, because the new lender will see the massive collateral charge registered by the big bank and refuse to touch the file. You are legally and financially tethered to the institution that is demanding the lump sum, held hostage by the fine print you signed 5 years ago. So, how do you defend yourself against a trap that was set half a decade ago? How do you survive the renewal reckoning when the bank holds all the cards? First, you must break out of the paralysis of denial. Do not wait for the renewal letter to arrive in the mail. If you have a variable rate mortgage with a fixed payment, you must assume you are in negative amortization right now. You must log into your banking portal, pull your mortgage statement, and look at the principal balance. Compare it to the balance from last year. If the number is going up, you are in the trap. You need to calculate the exact amount of the accumulated shortfall immediately. But knowledge is your only defense against the algorithm. You cannot negotiate a solution in the final 30 days of your contract. You need months of lead time to restructure your life and your finances. Second, you must proactively attack the principal before the bank forces you to. If you are 2 years away from renewal and you see the negative amortization growing, you need to change your financial behavior immediately. You must utilize your mortgage prepayment privileges. Most contracts allow you to increase your monthly payment by 10 or 20%, or to make annual lump sum payments without penalty. You need to redirect every available dollar, tax refunds, work bonuses, the money you save by canceling vacations, directly onto the principal of that mortgage. You must manually force the principal slice of the pie chart to exist. By making small voluntary lump sum payments now, you are chipping away at the massive involuntary lump sum payment the bank will demand at renewal. You are shrinking the target on your back and showing the bank's algorithm that you are actively managing the debt. Third, if you run the math and realize that the impending payment shock or the lump sum demand at renewal is mathematically impossible for you to meet, you must take control of the exit strategy. Do not let the bank dictate the timeline of your ruin. It is infinitely better to sell the property on your own terms in a controlled manner than to have the bank initiate a power of sale. If you sell voluntarily, you control the real estate agent, you control the staging, and you can fight for the highest possible price to preserve whatever equity you have left. If the bank takes over, they will sell the property at a distressed price, charge you tens of thousands of dollars in legal and administrative fees, and then sue you for the deficiency judgment to cover the shortfall. Selling your home is a heartbreaking decision, but losing your home, your equity, and your financial future to a bank foreclosure is a fatal one. You must amputate the bad debt to save the financial body. The great deleveraging of the Canadian economy is not happening through a sudden, dramatic stock market crash. It is happening slowly, quietly, month by month, inside the mortgage statements of the middle class. The banks are using negative amortization as a sponge to soak up the wealth of a generation, and the renewal date is the moment they wring that sponge dry. They are transferring the consequences of a volatile macroeconomic environment entirely onto the shoulders of the individual homeowner, perfectly protected by the federal regulations that were ostensibly designed to keep the system safe. The system is safe. The banks are safe. It is the homeowner who is being sacrificed to maintain the balance sheet. We will not stop uncovering these mechanisms of wealth extraction. In our next investigation, we are going to look at the other side of this crisis. We are going to expose how the government and the financial system are targeting the specific survival strategies homeowners are using to avoid the lump sum trap. We will look at the sudden, aggressive crackdown by the Canada Revenue Agency on basement rentals and secondary suites. And we will reveal how the government is placing tax liens on properties for undeclared rental income, and how those government liens are giving the banks the ultimate excuse to bypass the renewal process entirely and call the mortgage in default immediately. The walls are closing in from both the banking sector and the state. You cannot afford to navigate this collapse blindly. Subscribe to Canada Property Watch. We are reading the regulatory guidelines, we are analyzing the underwriting algorithms, and we are listening to the whistleblowers inside the financial institutions. We are here to give you the harsh, unforgiving truth about the mechanics of the housing market so you can see the traps before they are triggered. The era of the set it and forget it mortgage is dead. The era of financial vigilance is here. Review your statements. And attack your principal. Prepare for the renewal shock, and never assume that just because you are making your monthly payment, your home is truly safe. The bank is always doing the math, and in the end, the math always favors the bank. Ensure your financial survival by staying one step ahead of the institution that holds your title.